In this video, we're going to further discuss IUL, so cash value life insurance. In part one of this video, we discussed reasons why you may want to use that and some pros that it could have to an overall financial plan. In this video, we're going to break down some of the reasons why you may not want to use IUL, the cons list, if you'll call it, and some areas, again, you want to look out for when trying to decide if you're going to use IUL as part of your plan. Enjoy. Welcome everyone, I'm Logan Sadler. Thanks for stopping by the channel. For those of you that haven't done so yet, click like, subscribe. Also leave us some comments on maybe some other videos you'd like us to do on some other topics. Be happy to get to them. In today's video, I wanted to further our conversation on index universal life insurance, on cash value life insurance. Again, a very big topic for a lot of you out there that are looking into retirement plans and strategies, tools, and all these different solutions out there. This may be one that comes up. In part one of this video, we discussed the pros, reasons you may want to look into this as part of your retirement plan. As I say about pretty much every investment out there, there is positives and there's negatives about pretty much everything you do, right? In your situation, you want to make sure the pros outweigh the cons. In this video, I'm going to talk about the cons, the things that you really want to look out for when doing your research on IUL and if it should be a part of your financial plan. So going over with number one, they have, we talked about the way they make money off the indexes in part one. In this video, I want to talk about the main thing you want to look at too is cap rates, par rates, right? They may have limited earnings would be number one. So, just because if you're in the S&P 500, if the S&P 500 goes up 20% a year, that may not mean you made 20%, right? You may have a cap rate of 10%, 5%, 15%. It depends on the insurance company and what you have, right? So what the cap rate means is you only make up to the cap. So if you have a cap rate of, let's say 8%, if it goes up 10% on that index over your crediting period, so let's say August to August of this year to next year, over that, if you have an 8% cap rate and the S&P went up 12%, you would only make 8%, right? So there is some limited upside there. Again, some of you may still say, man, that's a pretty decent return. I'll take it, which may be true for a lot of you. But also some of you may say, well, I was hoping to maybe try to get a better return, right? That may be some reasons to look at it. They also have a participation rate on some of them. So if they have a 80% participation rate, you may only get 80% of whatever that index does, right? So there's always a little bit left off the table. So that could be one of the cons you may want to be at least aware of, right? Number two, there is no guaranteed returns. To get in the weeds, there is a fixed interest account on a lot of these IULs that can have a 3%, 4%, maybe a 5% crediting rate. However, a lot of these are not, the whole policy itself is not guaranteed based off those, right? So you want to make sure when you're looking at that, you're not guaranteed a 10% rate of return or 5% or whatever it's illustrated at. You want to make sure the indexes you're participating in, you understand what their potential is on the upside, but also what the potential is on the downside. Number three, most importantly, I would say is cost of insurance. When you're buying anything you hear the word insurance about, you got to understand that there's probably a cost for that insurance in there. Now, for those of you that are younger and healthier, probably not much, right? There's probably not a lot of cost in there. For those of you that are older and more unhealthy, there might be an extreme amount of cost that might make this worth having a little bit deeper of a conversation of if it makes sense, right? So understanding what you're paying for the cost of insurance to keep this train rolling, right? You want to understand how that breaks down. Number four, fees. Fees and expenses inside of some of these can be really high, right? Some of them can be actually very low, but a lot of them can be very high too, depending on what bells and whistles you have in there. There could be a variety of different fees broken down. Some of them I have listed like premium expenses, administration expenses, fees, commissions, all of that could still be wrapped up in how they price these products. Fees are not bad. I always tell people fees are not a bad thing, but you kind of want to make sure you're paying a reasonable fee, and that if you are paying a fee, making sure you're getting the value out of that you would need, right? Or maybe that you couldn't get elsewhere. So look into what you're paying is another thing to look at when, before getting into one of these. The fifth one that I would look at too, that's not as advertised on the internet. I see you can put money in, put money out, do this. You can do a lot of different things with these. However, understanding that these are typically a longer term investment. And typically they will have a surrender charge, right? So meaning if you put all your money in there, there may be a cost to get your money out next year, 5 years or 10 years, depending on what contract you have, what state you're in. All of that could be dependent on the insurance company and how that product is structured. But understanding that there is some surrender charges in there. There is a time limit of before you really want to touch your money, or it may cost you, right? And if you are going to touch it before then, understanding what that cost is and what's associated with it. So again, I think we did a good job of breaking down the positives of IUL and looking at some of the negatives or some things you may want to look into further to decide if it's something that fits in your plan. Like I said in the last video, any type of investment out there is going to have positive things and negative things. You really want to make sure that when you're looking at financial planning, you have tax planning, right? You got investments, you got all these different types of things you want to throw in there, making sure that if you are using IUL, you understand the ins and outs of it, and not just IUL, but maybe any investment as well, right? So thanks for stopping by. Hopefully you learned something about the insurance world. And if you have any other questions on that, comment in here below. Love to answer any questions or do some other videos on some other topics. Again, thank you. See you soon.